Hi everyone, welcome back to another True Potential Do More With Your Money podcast. Have you ever asked yourself how much you need to retire? Lots of people have, and we're going to try and answer that question today with some handy little calculations for you. But before we get into that, let me introduce my star panel who are on the podcast this week. I've got Hayley Mack at the end of the table, their operations supervisor at True Potential. In the middle, James Wood, financial advisor, and right next to me, Tom Robertshaw, who's also a financial advisor. Welcome, everybody.
Hello.
Hello.
How are you doing?
I'm good. How are you?
Yeah, very good, thank you. Yeah, not seen you on the podcast for a while, Tom.
I know, it's been a while.
What did you do wrong? Doesn't matter.
No.
I want to talk a little bit today around, well, I'll just go back a little bit because there's been quite a bit in the news lately around this idea of, retiring early and kind of what pot you would need. I see quite a lot of articles about this, and you hear people on TV talking about this idea of this FIRE movement, which we've talked about before on the podcast, this idea that if you put loads of your salary away and you just bank it up, you can retire dead early. But it's a little bit extreme. So I wanted to talk about, is there a more sustainable, a more sensible way that you can have a life but also retire reasonably early? So we'll get into some of that in a minute. But that then led me into thinking that probably we should just discuss the state pension, triple lock, some of that stuff, because that's also been in the news recently for a very good reason, Tom, which is that the state pension has increased.
Yes, it has.
Just recently.
Yes.
So would you mind giving us a quick update on exactly where we are with the state pension,
Yeah.
what people can expect, and what the different sort of rules and things are?
Yeah, certainly. So, I mean, the state pension currently at the moment is, well, this tax year has gone up by 8.5%, which is in line with the triple lock, which is something I'm sure we'll cover in a second.
Absolutely.
That is a further increase from last year. Last year it went up by 10.1%. So we've seen some significant changes and increases in the state pension. Now, the state pension currently is just over 11,500 for a full state pension.
Yeah.
And that would mean that you've contributed more than 35 years worth of national insurance contributions to get to that stage. So it's obviously increased by quite a decent amount over the last 2 years, which has been good. But it's still certainly not enough to cover the majority of people's retirement needs. If you look at the average amount that is needed from a joint couple basis in retirement, it's around about £34,000. That increases if you're in London to about over £41,000. Sure. So it's certainly not enough to cover you all the way, but it certainly helps from that perspective.
Yeah. And in the state pension, obviously, you know, there's a bit of talk, you know, if you ask people, we've done podcasts about this, we've done surveys, it's odd because people have a bit of, or a lack of confidence that actually it's going to be there when they come to retire, isn't it? I mean, it's one of these things that, you know, you sort of hope will be there, but it'd be a mistake to sort of bank on that and assume that that's going to cover you, partly for the reasons Tom said, as in it's not a huge amount in terms of if you wanted to have a comfortable retirement, but it's some doubt also whether it'll even be there in the future.
Which is really true, because we're seeing, along with those rises, we're also seeing a raise at the minute in terms of when it is we do receive our state pensions.
That's right.
Which, obviously, the increase is great for those who are in receipt. But for those who are yet to be in receipt of that, they aren't feeling those changes just yet. In fact, what they're feeling is that it's getting further and further away.
Yeah.
So, you know, for people born after the 5th of April 1960, their now state pension age is currently sat at 67.
Yeah.
So previously we have seen 65, 66, where most people who are in receipt are kind of sitting at, but 67, you know, that is getting further down the line, and it's expected only really to go up from there.
Yes.
For those of us who are younger, the worry is at which stage will we even see our state pension kick in. Yeah. And it's something that obviously clients are concerned about, because we will look at state pension as a plan, but it's only part of that plan, and it's about what else we do to really get there.
We've seen some interesting stuff come out in the press from the International Longevity Centre UK recently, which has published a report earlier this year, and they stated in that report essentially that we're going to have to increase the state pension age to 71 by 2050, which is obviously quite a large increase. If you look at the planned increases at the moment, you know, state pension age is due to go up to 67 between 2020. 6 and 28, and it's expected to go up to 68 between 2044 and 2046. So they are a little bit off at the moment in terms of what the international.
Well, we're nudging up against 70, aren't we?
Yeah.
We're getting there. So
we're
getting,
getting
as you say, we're not going to be far off it being in the 70s, in your 70s before you get a state pension. So this whole idea of retiring early, I mean, we're going the other way in terms of the state element. Yeah. Hence why we're going to be talking shortly about what people can do about that. Do you find, Hayley, when people perhaps get in touch, whether it's online or ringing up, there's a lot of confusion around the state pension, partly for these reasons, which is that, you know, you've got to be, you've got to be really up on this to understand when it is for you, when it's going to kick in, how much you might get. Is it something that people get in touch with us often about?
They do, and I also think this comes down to the fact of people in what age they particularly want to retire, because they've already got savings in their pension. I think from us and from our perspective, it's not something that is an easy topic. I think it's quite confusing. People maybe necessarily don't know what is the best thing to do, when the right thing is to do it. So in that respect, we would always just recommend that they speak to a financial advisor. But it is quite a common thing that we get, and it's kind of, well, what should I do? What tax implications? Like, what do I need to do from this point? And it's not something that anyone knows. It's not a black and white answer. It's different for each individual's person's circumstances. And from that point, it is a conversation that's needed.
Because there would have been a time not that long ago when people's ambitions to retire maybe around the age of 60 align nicely with when you got the state pension. I'm going back several years now.
Yeah, definitely.
But those two lines have got much further apart now from when people want to retire. Maybe they still have an ambition to retire late 50s, early 60s. But as you say, that the gap now between what you're going to do for those intervening years before the state pension kicks in, that's just getting further apart.
But that's the beauty of, defined contribution pensions, where you've got that flexibility there to take a little bit more before you get to state pension age, and then drop it down once you're at state pension age. And one thing we always, me and James will always say to clients, is it's actually quite easy to see what your state pension is. You can just log onto the Government Gateway website and it'll tell you what your state pension is projected to be. Or you can complete a BR19 report, which is like the old-fashioned paper-based version of trying to get that. So you can get all of that information to hand, and when we're doing drawdown reports and looking at a client's sustainability of their pension funds, we always ask them to get that state pension income.
It's such an important part, because we can build the best laid plans, but this is such a major component of income coming in at some stage. So I certainly, the same as yourself, as you just mentioned, Tom, will always push people towards the HMRC calculator from that side. It gives you a date, it gives you the amount that you're due to receive or expecting to receive. It's a really useful tool for us.
Until the rules change again. And then
the rules change again.
So it might be right today. That's about the best you can hopefully get from it. I mean, there's been talk, isn't there, about the current government, if they're to stay in power, that I've heard them talk about wanting to abolish national insurance altogether, which of course is what funds the state pension. Wanting to abolish it altogether over the next 5 years does make you wonder if you do manage to abolish national insurance. That's good for workers because, of course, it comes off your pay. Pension people who already stopped working in receipt of pensions don't get that kickback because they're not paying an eye. But you wonder how the state pension could possibly be funded then. If there's no national insurance. I mean, you'll have to fund it from somewhere.
If you look at that as well, it currently costing the government about £110 billion, which is obviously half of
huge amount.
It's nearly half of their whole state benefits budget is on the state pension, and that's before we took in the increases of the 10.1%, the 8.5%, that figure. So probably even high. Well, it will be a lot higher than that now. So it does beg the question how they're going to fund this.
I mean, when you say 100, and it's going to, I think it's projected to rise to about 124 billion in the next few years. Which, when you put it into context, that's probably more than we spend on defence, more than we spend on education, more than we spend on police. Altogether, it's a huge sum of money. So, but of course, you mentioned the increase in the state pension. That's because of the triple lock. So, for anyone that doesn't know, just remind us, if you would, James, what is the triple lock? What are the three things that make up the triple lock?
Okay, so the triple lock is obviously what is causing, as we've mentioned, those increases, but there are varying increases we may see in the future, and it's dependent on three things, as you rightly mentioned, which is inflation, consumer price index, and that's based off kind of the previous September before any of those would come in at that stage. And another factor that they can look to use is the average increase in earnings, which obviously is quite a good indication of what's going on within our cost of living. The final one's 2.5%, and it seems like a bit of an outlier when we have these kind of two larger figures to look at and then just 2.5%. But it's nice to have in the background because they will select the highest of those three to increase by. So it goes to show that if we, obviously not the period of time that we're in at the minute, but if we were in a period of time where earnings weren't going up by that much, inflation wasn't particularly high at that stage, then at least we're going to see an increase of 2.5%.
And with the Bank of England target of inflation being 2%, at the very worst case scenario, you're going to be getting just above what the Bank of England says is its ambition. Although, as you say, we've been in very strange times.
And it just means it is almost a guarantee that's there. While that's in place, of course, the triple lock, it is a guarantee that we're going to see that increase. And that's a little bit reassuring, but it's also nice for people to see. Again, 2.5% in the grand scheme of things isn't a massive increase. When we see these 10.1 and 8.5% increases, 2.5 seems quite low. But it's just there to make sure that we will see them regardless.
And I noticed that the current government have committed that they would, obviously it was their own policy, I guess, from 2010. So they've committed to keeping it after the next election. I think the Labour Party's been a little bit caught in that, just because obviously want to get in and see what actually the state of the books might be before they make any big commitments. As you say, Tom, it's a big commitment.
It'd be interesting to see what they do with that, though, because obviously they've said, in various press articles, they've said that Labour are going to keep it, but we don't know because we haven't seen the manifesto yet. So it'd be interesting to see if they do keep it.
And as you say, when it's probably the second biggest spending you do as a government on welfare, you want to know that you what you're committing to, I guess. Hayley, just going back to in terms of the technology in the app. So I know that when I go into my True Potential pension and I have a look at it, you can include state pension in your forecast. You can get a real idea of how it's going to, because you made the right point before, which was around people's individual goals. And when you're thinking about the kind of retirement you want and what you want to do, you want to include obviously your own pension, your personal pension, but obviously having the state pension is part of that mix.
Absolutely.
And the technology here can give you that forecast, can't it?
It can do that, and as I said before, every person's retirement looks different. Some people want to take lump sums, some people don't want to touch it, and it just really depends. But the technology that we have really offers a black and white of if this is what you could potentially have, and including it in there as well, which I think for people making their own decisions and kind of looking as to what they want out of their retirement, when they've got it there in front of them, it's an easier decision to make, really.
Right, so we said at the start, all of the state pension, triple lock, it's all there, but wouldn't it be much better if you could take control of your own finances and not have to worry about any of this? Because it must be tricky if you're banking on this money and then the rules change or someone else comes in and tears up what the last lot did and you think, well, that was great, I was planning for that. So what we're going to chat a little bit now is about, if you want to take control of your own money, there is this concept called FIRE, which is financial independence, retire early. But when you read about it, it seems crazy, right? It seems like you've basically got to put away almost every penny you can of your income and just have no life. Right? Who wants to do that? Have you read about FIRE? Have you come across it?
I have, yes, and I think the concept's insane, to be honest. Like, you come to work every day and you need some time for yourself and you need to enjoy your life. And I know saving for your retirement, it's where you kind of can spread your wings and do what you want with your time, but you need to be able to live and have some work-life balance. It's insane.
Absolutely. I mean, is it something that people have ever, as advisors, do people come to you and say, look, I want to be able to jack and work when I'm in my 40s, how can I do it? And is it something that people sort of ask you about?
I've had one person to the top of my head who has come to me in terms of wanting to make contributions. And the levels of contributions we were talking about were quite frankly staggering, even to myself with the clients that I speak to on a day-by-day basis. As Hayley's rightly mentioned, you've got to be able to enjoy yourself. Yes, our pensions are very important, and it is important that we contribute to them, and we'll touch on kind of the best ways for that. But you have to be able to live. And even in the rising costs that we're seeing at the minute, it means, and I believe it's up to 70%, Peter, isn't it, that they're saying of your salary to
something like that. It's an insane amount. Time you've you've maybe covered your mortgage. I mean, you'd have nothing left. You wouldn't be able to do anything.
No.
You'd have a house, but good job, you'd be in it all the time. You wouldn't be able to go out anywhere and do anything. So it is crazy. Have you ever thought about having a crack at FIRE, Tom? No. Is it not something that's thinking about?
To be honest, it's quite like a young movement, isn't it, as well? And I just don't understand why you'd want to not be able to live your youth and enjoy yourself. And I'm sure all of those people who are sort of going through this will probably look back and think, I wish I just went a bit easier on myself and didn't contribute as much as that. But there's much easier ways of doing it than having to put 70% of essentially of your earnings into investable assets. I think you can put, you can. With us, obviously, you can set up direct debits, and then I know nowadays that a lot of people have sort of maybe monthly bonuses or annual bonuses, and that's where obviously the impulse save feature comes in really well. So what I always say to clients is, look, if you've got a monthly income and you don't know exactly what you're going to be getting every month, put in the minimums amounts as a regular direct debit at the very least, and then use impulse save and get into a habit of using impulse save. Because if you just do here or there and everywhere, you're not going to really get into that habit. And it is definitely habitual. All of this is making sure that you're doing it on a regular basis, and you'll benefit from it.
No, I think just from like my own personal experience, if you look at that, so I personally have a direct debit that's set up at the beginning of the month, which comes out, which is basically the minimum that I know that I can afford to put into my pension for that particular month. Then I also use Impulse Save, like you said, Tom, and what's really good about that feature is you can set up reminders. So on the last day of the month, I'll get a reminder to say you haven't Impulse Saved yet, and it's a spur on for me to go, right, okay, I haven't done it yet, what have I got left over for the month, and kind of influence that decision in that way as well, which is, it's a really useful tool for those who don't use it regularly. Because even though I do it'll get to the end of the month, you're busy doing kind of home life things and you forget, and it's a useful tool to have.
Yeah. I mean, but there are, there are other strategies, aren't there, where you can retire early with a decent pot, but there are some things that you probably need to do early to get into that habit, isn't there? So maybe we come up with our own triple lock, right? Here's our own triple lock. How about this one? Start early. We'll talk about some of these, what we mean by how early you should be starting, all the rest of it. But starting early, saving enough, and and obviously taking financial advice along the way. So you've got someone by your side guiding you through. They'd be good. They'd be three very good things you could do, isn't it? And also, here's another one. Maybe it's the quadruple lock. Is the right risk category? But I suppose your advisor would advise you on that.
Yeah.
Talk us through some of those things, Tom, that you could do if you're watching this and you're in your early 20s and you're thinking, the state pension me is light years away and getting further away.
Yeah.
Right. I don't fancy giving away 70% of my income into a pension because I do actually want to have a life. But I quite like the idea of being able to retire early. What are some of the things that people could do? Perfect.
I mean, from my side of things, first of all, contributing to a pension, because a lot of people, I know we all do because we're in this environment of true potential where we can see it every day, but a lot of people don't, unfortunately. So that's the first thing, and you'll benefit from it, both your personal contributions and your employer contributions as well. And if your employer matches your contributions, then increase those contributions because you're getting free money essentially from the employer there. Yeah. The other thing is risk, which is what you mentioned there, which is quite an important thing to touch on really, because the longer the term, the more risk you can take on. Now, of course, look, we would always go through a risk tolerance questionnaire when determining risk, but a lot of my friends say to me, look, what would be the one piece of advice that you would give to me in terms of saving? And a lot of the time I say, look, you can take on a little bit more risk. Don't be just when you're younger, you can take on a bit more risk, and then as you get closer to retirement, you can then start dropping it down and lock in those gains that you made, and that can make a difference of hundreds of thousands of pounds for somebody who've got 30 years to retirement. Like, unfortunately,
this is the really weird thing, because I remember when I was 21, which is a long time ago now. I remember I was self-employed at the time and a financial advisor. I've got to say, the best thing that ever happened was said to me, you need to start your own pension now. And I thought, look, you're the advisor. You're in the know. I'll do it. And it was the best thing that I ever could have done, because it got me into the habit of saving. It's had a long time now to build up a pot, but and I feel like that was a massive thing, which at the time in my 20s I didn't fully appreciate how significant that was. But as I've got older, I've thought, you know what, if I got into my 40s and then thought, oh, I really now need to really get cracking on my pension, I would have missed maybe 20 years worth of that. And as you say, the market's doing the work of the compound growth on that. It's we can't stress the importance of how important it is to start early.
I was actually staggered when I first started here of how much you needed for a comfortable retirement. I think when you look at it and you say you want like £20,000 a year, and then you see the end figure and you think, God, like, I was just like, for me personally, before I started in this industry, you think, oh, I'll do it in a couple of years' time. It's not important right now. But the amount that you need in a gross figure, it's quite substantial.
Well, we should put some numbers on that. I mean, what kind of pot should people be thinking of if they want to retire? Let's say at 50, right? Which is nearly 20 years before the state pension's going to kick in, as we said before. So you need to have a sensible pot yourself. You want to quit work, in this. I mean, I realise most people probably don't retire at 50. It's much later. But in this concept of getting an early retirement and working towards that over, say, 30 years of your working life, what kind of pot would you need at the age of 50?
Well, it comes to, at that stage, what I always call, and we laugh about, the impossible question of how much do we need, and how much do we need in retirement, because we're talking goals that are down the line, and even if, say, in this example, someone was to retire at 50, who's to say their expenditure would be the same at 60 or at 70? So for us, it's really important, if we're talking about this 50, we have to have quite a bit of diversity within our investment portfolio, because legally at that age we wouldn't be able to access our pensions. So we need to then see multiple assets there and things that we can really delve into and utilise at that time. But putting a number on it, as I say, it's a difficult question. I think
there are some calculations you can see. I mean, there are things like you need 25 times your income, for example.
Or look at it from a backside at how much you want to be taking out, and then build things from there. I mean, we would always recommend a 4% safe withdrawal rate, and you could look at what that is, run the numbers backwards, and then see what our goal might be at that stage. But it's something through both a little bit of planning beforehand, but also when it comes close to that time, a conversation with an advisor and run through some modelling, some cash flow modelling to go, okay, well, this is what we have and this is what we've worked really hard to build up. How will that work for ourselves over the coming years? And it's
well,
really
if you let's say you got to 50, you might have you might not have cleared your mortgage, but you might have paid quite a chunk of your mortgage down, so you might have reasonably low payments. If you wanted to spend, let's say your annual expenditure was 40 grand, you're going to need £1 million pot, right? At 25 times that, and then doing the 4% withdrawal. So can you get to £1 million? Critical question: can you get to £1 million without sacrificing any social life at all? If you started at, say, 21, your first job, you increased your, because I think this is the other key thing, what you can afford to put into a pension at 21,
it's going to be different.
As your salary goes up over your 20s, 30s, 40s and 50s, you can increase those contributions. Is it doable?
Yeah, absolutely. Absolutely. I mean, it sounds like a lot, but even £500 a month over a 30 to 35 year term, we'll get close to that. I've done the calculations myself because I was looking at it, and
Go on,
obviously,
tell us, what do we need to do?
It's that that's not a huge amount of money that you have to contribute every month
with those employer contributions, with the markets doing the compound growth,
and obviously being in that's having like a good level of risk early on, and then tapering that down, further down the line. Now, the thing is that I don't really like saying, what's the magic number of the pot, because there isn't actually a magic number. You've got to take into account the first thing we always look at is expenditure. What is your retirement expenditure first? Which is obviously what you've done there with the £40,000. And then we work backwards from there. So we'll look at state pensions coming in, we'll look at defined benefit pensions if they have them. We'll look at if they're going to pay off the mortgage, and that's going to reduce their expenditure down at a certain point. We'll look at cash assets. So that's why, using the True Potential 1 goal and cash flow modelling, when you get into 50 or you're getting close to your retirement and you're thinking, have I got enough? You need to speak to your financial advisor, and I'm sure everybody who's listening will have a financial advisor, and they can go through those cash flow models, because I always say a good 5 years before you're planning to retire, that's when you should start going through those at the very least. You should really be doing it from the start if you're a good financial advisor, and it helps to keep people. Helps to make sure that you're on track to where you need to be, because there's a lot of different moving variables like inflation and growth rates of investments that you've got to factor all into account, and we can provide all that advice for you and make it very graphical so you can actually see it.
I mean, your point around the attitude to risk, I think, is really important, because naturally people gravitate. I remember, again, going back to when I was in my 20s, you get, people have changed now, but the classic sort of attitude to risk form of, and you naturally just go, well, I'll just go straight down the middle.
Yeah.
It depends how the question is phrased, isn't it? How much risk appetite have you got? Well, I don't know. I mean, I'm probably just average. So, but actually, what you say, when you're in your 20s, you've got decades till you need that pension. Yeah. You can't even access it for decades. So, there's an argument to say, depending on a proper conversation with an advisor, because of course all these things should be done with a proper conversation with a regulated professional advisor. But you begin to open your eyes and think, actually, I get it now. I can take more risk early. All I'm really doing is, if you like, putting more of that pension into markets and equity, and perhaps a little bit less into bonds and things like that. That's all you're really doing, isn't it? Getting the market to do a bit more work for you. Is attitude to risk something that people you don't quite understand or need a bit of help with to understand where they would fit?
I think the don't quite understand bit would be a little bit cruel to say about people, but I certainly think it's one that people have a lot of questions about. And as Tom's discussed, that phase where we get closer to our retirement, the attitude to risk starts to almost play more of a factor for clients, because they're a bit more concerned about, okay, this is my money for retirement now. I've done, as we've discussed, I've gone all out for all those years, and now it's come to a stage where, okay, well, I'm very close to that retirement. So I think, as I say, it would be a bit difficult for me to say that someone maybe doesn't fully understand it, but it's certainly something that I think causes clients a lot of concern when they get close to that time, and it's why we will always.
But there must be a reason why most people end up down the balanced route, when perhaps they needn't be. If they had a proper conversation with an advisor about, what does it mean? If I go, totally,
And I think a misconception is that when we do start taking, say, a level of income out, we're not looking for any growth within our pot, because we are just taking an income out of it. Now, for some clients, that's absolutely the case. But for others, we're planning withdrawals of 20, 30 years, hopefully, depending on how long, one survives. But that's what the goal would be. Yeah. So if we look at that in terms of how many years we've been contributing in, it's almost the same amount of time. And it's really important, I think, when I have conversations with clients, we make that point, and then it almost is a flick of the switch. And I understand it's not just about the next 5 years, it's really about the next 20 to 25 years as well.
Again, there's another thing about the app, Hayley, I like, and the client website is when you obviously one of the first questions is what's your goal.
Yep.
Now, let's say your goal was I want £1 million pension pot, right? And it'll show you what you need to do and whether you're behind or ahead of that goal, and if you're behind it, what corrections you can make in terms of your contributions or impulse saves. Tell us about some of the things that people can do. Just tell us how that works. If we've got a new client watching this who's not yet registered on the app, maybe thinking about joining True Potential, how does the tech help you do it?
It helps in a lot of ways. So one, it tells you. It shows you in a nice graph. It'll actually tell you kind of how much you need to get to that goal in that particular time frame that you've set. It gives you reminders, like I say, the impulse save reminder. It allows you to set up a direct debit. But one of the other things that we've got within the technology that we haven't touched on yet is the rewards.
Yes.
So the rewards for me is one of the most like simplistic propositions because you're already spending the money. And you are getting a reward back for spending that money. So it can be on general household things, it can be on takeaways like Just Eat's on there, and it's kind of well-known common brands that people spend money in every single day. And that is a percentage back, it's like a cash back, and that is either invested back into the investment or you can take it out as a cash withdrawal as well. But that for me, when I'm speaking to clients about kind of their savings and what they want to do, it's one of the most easy, straightforward things to do. They can do it by logging into their app. It's companies like Booking.com who people use frequently, B&Q, Marks and Spencer's is on there, and you're already spending the money. Which is what I try to speak to people about, is you are already going in there and spending £50, £100, whatever it might be. Why not get the cash back? And it's not a strenuous thing that clients have got to do. It's a Google Chrome edition that you can put on your phone, on their laptops, iPads, whatever it might be. And it literally highlights at the top of the Google browser which companies you can get True Potential cash back on. And one of the examples for me was I've recently been looking to buy a new pan set, which is really exciting. But for me, B&Q had a cash back on offer, so why would I go elsewhere when I can go to B&Q and get the money back for buying pretty much the exact same thing. But
Great.
yeah.
Mine's a little bit more sad than that. It was a new drill from Screwfix. But I'll take cash back wherever it comes from.
Exactly. It's money that you're already spending. So I know that I knew I was going to spend money on pans. So why not get a reward off doing that?
I mean, I hate the fact that we're stereotyping. You bought a drill and you bought some pans. I mean, I'm sure that,
I do need some pans in fairness, Peter, so maybe that might be the next purchase for me.
You can buy the drill and, yeah, exactly. Just go and try putting the picture up with your pan. I mean, just need a drill for that point. Anyway, have you bought anything on any rewards?
No,
have you been to B&Q lately, Tom?
I haven't actually.
Any shelves to put up with?
No. But you just remind me, I didn't actually realise that Booking.com was on there, and I'm going to get my holiday on that because the bigger purchases you get more.
Do you know what it is? Booking.com about 2 months ago now had a reward of 12% on. And it was like absolutely unbelievable. Like I booked my friend's hen do. I'm not going to say any spoilers because in case she watches it, and she'll know where we're going. But I booked it on that, and it was a house with 15 people, so it was like in the thousands that we'd paid for it, and we got like money back on that. So it was.
Well, I love the fact that you could book a holiday, get the cash back, which goes into your pension, which helps you retire early and have more holidays.
Exactly.
And on you go.
It's a full circle.
I love that.
It's been going through my head as we've been talking about, we've talked about people starting early.
Yeah.
Well, obviously we've got to realise younger people have different priorities, which is purchase a house, say, for example.
Exactly,
Now, when they purchase a house, they're most likely going to need a drill, a pan set, probably not the holiday. That might go out the window at that stage, but little things like that, which at one stage in their life will become quite often, and I believe Curry's is on there as well in terms of that. You're going to have to kit out your house with appliances. That can be a silly thing almost, but something that could impact
and Just Eat's
down
on
the
there
line.
so you can get the other type of curry as well.
Exactly.
This is it.
There's
and every
thousands.
time you do it, the money's going back into your ISA or your pension. So we're all helping. I think this is great. I mean, there's loads of ways you can do it, and all of this, as I say, on a serious point, is helping those pension contributions creep up and creep up and creep up, which is the whole point of this, is how can you retire early, how can you reach that lucrative £1 million, which, as you say, Tom, sounds like a lot of money when you think of it, but actually when you've got all these ways to get there, the market's doing a bit, the rewards doing a bit, your employer chipping in as well. As long as you increase those contributions every year as well, as your pay goes up, you get a bonus, chuck a bit into your pension, go and enjoy the rest. All good stuff, isn't it? It's all loads of different ways.
You've got your tax relief as well.
Yeah, of course.
So
and you get your tax back as well. Do you think? I mean, what would be if you're maybe, as I say, in your 20s, you're starting out in your work. You get this. You have automatically enrolled now into a company pension. And you might think, well, that's job done. I'm surely that's me taken care of. Is it enough? Is that going to get you there?
I mean, the problem that you've got nowadays is obviously because there isn't defined benefit pensions as such as what they used to be in the past.
Yeah.
Obviously, the contributions going into these pensions aren't actually a large amount, and that's why, just having, being on the minimum auto-enrolment amount is probably not enough to get to where you actually need to be. You need to contribute more, unfortunately. And we're very well aware that as you get older, you're going to have more disposable income. You go through different phases in life, don't you? You have a family, you don't have as much disposable income then because it's all going on the kids. Then you get into your 40s and, they might have flown the nest at that point, so you've got a bit more disposable income then. So it's just... that that's a beauty of impulse saving, the flexibility of that, where you can actually increase and decrease the amounts that you're putting in there to sort of meet what's going on in your life, really. So there's plenty of opportunity there to put the money in, I'm sure.
So I think we can safely say that nobody's doing fire, right?
No.
Never mind fire. Let's put the fire out. Right?
I want a life.
Absolutely want a life. But we agree that it is possible to get to a stage where you could retire early without having to sacrifice your life. You've just got to. Well, what are the 3 rules? Let's go over them one more time, Hayley. Give me something that people could do early in their life, which would help them be able to retire early. What's your favourite little top tip?
I think setting up a direct debit. I think regular payment. I see my direct debit as a bill.
Yep.
I see it as my monthly outgoings, and it's like one of my household bills now. It's just there it goes. Yeah.
I think not just thinking your workplace pension is enough. If you have the ability to, a little bit into a personal pension as well, can make a big difference when it comes to that end.
Mine would be look at risk and make sure it's obviously applicable to you, and think about the term that you've got until you retire, and then also as well use rewards a little bit more, because I need to start doing that a bit more.
Yeah, absolutely. And as you say, the point about tax relief is really important. For all the more you put into your pension, you're getting that tax relief on it as well. It was you maybe
100%.
said it, Hayley, as well. So it's a little tax kicker. No, which is nice to have on the way, isn't it?
Yeah.
Great. Well, I'm reassured. As I say, I was reading some of this stuff in the news in the last couple of weeks about state pension, triple locks, fire, and it slightly all depressed me. I slightly all thought, state pension's getting further away. Triple locks, are they going to be around? Who knows? Have you got to put away all your income? And I just thought there must be a better way. And I think you've answered me and probably answered our viewers' question that there is a way to do this. You can retire early if you do some of the things you're talking about. Are you all planning to retire early? Is that?
I would love to.
Yeah.
I'd hope so. Yeah.
Well, you two must definitely be. You do all of it. If you want some advice, do you go to Tom? And Tom, would you reach somebody? Is that how it works?
I'd like to think so. I definitely go to Tom. He, for some reason, doesn't want to come back to me. No, it's always nice to have a peer to bounce an idea off. And just make sure that you are thinking the right thing down the line. We'll go to Hayley as well for the rewards now, apparently.
Of course.
We'll I know. Exactly you just need to get on that.
Yeah. Who's the best advisor? No, it's an unfair question. Look, I hope that's been useful, and I hope it's maybe as it shed some light on the things that you can do to get to that point. You don't need to do all this crazy stuff about putting all your salary away and not having any life. It's not what needs to happen. You can, as the guys have said today, there are things that you can do. The best thing you could do, of course, is speak to a financial advisor. Give us a call. Get on the website. Get on the app. We're here for you. Whenever you need that. And if you've got questions around any of this kind of stuff or anything else for that matter, just get in touch. And of course, another thing you could do is subscribe to this podcast, because we have these types of conversations every week. There's a morning markets that we do as well, let you know what's happening out there. So make sure that you do subscribe. Give us a like. We'd love that. And don't forget to join us next time. We'll see you then. Bye for now.